Good morning. This is the New York City Fire Pension Fund Investment Meeting. We are at One Battery Plaza on the 9th floor in the conference room. We have some attendees participating via Zoom. Today is September 18th, 2023. It is 10:13 a.m. We'll start with a roll call.
Good morning, everybody. And first order of business, before I call the roll, there's some new trustees I'd like to welcome for the UFA. The treasurer, Chris Viola, is joining us remotely. And for the UFOA, the lieutenant's rep, Joe Camastro, welcome. Happy to have you aboard. And chief's rep, Sean Michael. So I welcome you all to the board of trustees. Whatever we can do here at the fund to help your transition, that's why we're here. Let us know. We'll do everything we can to assist, and I appreciate your selflessness. Each and every one of you is putting up your hands to do the oftentimes weighty business of the union and in particular the board of trustees. So that being said, let me commence with the roll. For Mayor Adams.
Brian Berkey representing Mayor Eric Adams, present.
Okay. For Controller Lander.
Allison Hirsch representing Controller Brad Lander.
John Dorsa, alternate for Control, Brad Lander.
Okay. And for Commissioner Nyblack, Finance.
Phil Dukes for Commissioner Nyblack.
And for the UFA, Mr. Andrew Ansbro.
Bobby Eustace with Andrew Andros proxy.
Okay, Mr. Eustace.
Present.
Okay, Mr. Christopher Iowa.
Present.
Okay, Mr. Eric Bischoff.
Good morning, President.
Mr. John Young.
John Young, present.
Okay, for the UFOA, Mr. Joseph Camastro.
Present.
Mr. Liam Guilfoyle.
Here.
Mr. Sean Michael.
Here.
And for Fire Commissioner Kavanaugh, Lizette Kristoff.
Lizette Kristoff here.
We have a quorum.
All right, thank you, everyone, and welcome to our new members. I'm going to start by kicking it off with the Controller's Office for the public agenda.
All right, good morning, everyone. We have a very straightforward public agenda. We're going to start by turning it over to Steve Meyer, the Chief Investment Officer, and then we're going to hear a risk presentation and talk about asset allocation. So Steve, take it away.
Again, guys, who is speaking now and then who was the original speaker?
Sorry, that was John Dorsa from the Controller's Office.
Thank you.
And turning it over to Steve Meyer.
Thank you.
And Lizette Kristoff is who introduced it, turned it over to the Controller. Turned it over to John Dorsa, I should say.
Who is the man who did roll call?
Patrick Dunn, the Executive Director.
Thank you.
Great.
Terrific.
Thanks. Trustees, give a very presentation today. I'm going to try to give you an update on what's going on here. It's impacting market.
I'm not sure if this is true for everyone, but folks in the room, it's cutting in and out quite a bit.
Is that better?
For now it is, Steve, yeah.
Yeah, I think it's better, Kate. So, like I said, quick economic update, what's going on in the markets, and then more importantly, how all this is impacting your portfolio. So on the first slide, Kate, slide 2, thank you. The Fed, in terms of monetary policy here in the States, the Fed may not necessarily be done yet, although they're very close to the end of their hiking cycle. There's a meeting this Wednesday. The Fed is not expected to raise rates. But November 1st, there's another meeting towards the end of the year where Fed fund futures contracts are pricing in the 25% potential chance of another hike. The ECB and the Bank of England in Europe similarly restricted monetary policy and financial conditions. The Bank of England meets later this week, I think on Thursday. They're expected to raise rates another 25 basis points. But again, the ECB and the Bank of England are also close to the end of their rate hiking cycle. The Bank of Japan also meets this Friday, and they've been incredibly loose in terms of monetary policy. We may see some change, we may not. They've been very cagey in terms of the expectations there. So we'd be waiting to see how that pans out on Friday. And lastly, China is really the outlier from global central bank perspective, where they have sluggish growth and generally declining prices, and they are easing monetary policy as opposed to tightening. On the next slide, a quick look at inflation. You can see the CPI inflation has now moved below the 4% level. If you remember, in June of 2022, it was at 9.1%. It's now at 3.7%, so definitely moving in the right direction. Core inflation, however, on that screen, you really can't see it on the far right-hand side. It would be a yellow bar that shows core inflation still sticky at 4.25%. On the next slide, actually, can we change that? Oh, we can see that fine. This is another look at the super core inflation, which is persistently high. This is core inflation excluding housing. And you can see that's still a problem for the Fed, averaging between 4% and 5%. Another reason why we think that there might still be one more hike to come later this year. On the next slide, inflation continues to move lower around the world. In red on the far right-hand side, you can see a little bit of an uptick in the States. Some of that's energy related, but you can see a nice trend downward also in Europe and in the UK. Next slide. U.S. employment is still slowing, but continues to be very solid relative to monetary policy and expectations for a slowing economy. Average jobs created in the U.S. economy have averaged over 150,000 per month in the last 3 months. Although unemployment did tick up to 3.8% in August, 100% of that increase in unemployment was due to people re-entering the labor market, which is a positive sign for those individuals in the economy overall. On the next slide, a quick look at where we were in August. As I said, 3.7, 3.8% CPI on the lower right-hand side in white. But to the point I tried to make earlier, 62.8% is the participation rate. So people are starting to come back to work. We're still not where we were pre-pandemic, but we're getting much closer. On the next slide, quick summary of where we are in terms of economic growth. The U.S. is relatively strong. Europe is slightly stronger, but still weak. And China is disappointing relative to expectations. On the next slide, you can actually get a look at just how disruptive the pandemic was from an economic growth perspective. This is a 10-year chart. You can see the first 7 years pre-pandemic on the left, pretty smooth. A couple of blips along the way, pretty smooth. And you can see the dramatic dislocations that we saw in the pandemic and the aftermath. You can make a strong argument that we're really returning to normalcy and that this is not a typical business cycle. And people talk about a soft landing, and they may be actually misjudging where we are from a cyclical perspective. On the next slide, as I said earlier, interest rate hikes are nearing an end, both here and in Europe, but likely will be higher for longer. China's been cutting rates to stimulate growth, and Japan is still very accommodative, but they may at some point tighten their credit. To that point in the following slide, you can see the 3 upper staircases, if you will, starting at the top of the Fed, FOMC, the Bank of England, and ECB. You can get a sense for rates have moved up pretty dramatically and pretty consistently across the large global economies. One exception happens to continue to be Japan, which is way at the bottom in purple. They still have official rates that are negative 10 basis points, and they still have something that's referred to as yield curve control, where they're artificially pushing down the yields on their 10-year treasuries or sovereigns or JGBs, and that may change at some point. On the next slide, just a couple of things to note. It's really been a tale of 2 worlds in U.S. fixed income. U.S. Treasury markets have moved higher this summer. And when I say higher, I mean yields have moved higher and prices have moved lower. In fact, today, this morning, watching Bloomberg at the 5 a.m., I did see that the 10-year yields have actually hit an all-time high for the year to date at 4.34%. The other side of the fixed income equation is actually credit spreads. And credit spreads for investment grade and high yield are not pricing in a recession, have actually continued to tighten, even where we are in the policy of rate hikes. On the next slide, maybe just a couple basic things. So you'll hear me, you'll hear Doug, you'll hear Ed talk about base rates. And what that really means is the U.S. Treasury risk-free rate are considered base rates. If you look on this chart, the bottom gray bar, you can see that's a positively sloping yield curve that we had at the end of 2021. You can see short rates are lower, longer rates are higher, at 30 years or above where they'd be for an overnight rate. You can see on the top, this is where we were most recently, as of September 13th. Short rates continue to be higher than long rates, and that's an unusual circumstance. That's actually considered to be an inverted yield curve, and probably a temporary phenomenon, indicating that at some point we'll either enter a recession and or the Fed will cut rates, short rates dramatically and move back to a positive sloping yield curve. On the next slide, just a look at where we are with 2s and 10s. On the top, you can see them white. Those are 2-year yields. They're about 5%. And below that, 10-year yields currently, as I said earlier today, at 4.34%. If you looked at 506 today, where 2s are, it's still a 72 basis point inverted yield curve. Again, that's an unusual circumstance. On the next slide, so we talked about base rates. We talked about where we were with the Treasury curve and how it's below where short rates are. This is actually a look at credit spreads. So when you buy a bond, let's say it has a 5-year duration, keep it simple, 5-year maturity, the return you're going to receive on that bond will be the base rates, the risk-free rate of treasuries, plus the spread. And this is an indication of what that means. So for high yield securities, high yield bonds, that spread right now is about 380 basis points above that base rate. You get that in addition to compensate for the risk of default. And an investment grade below that, which are triple B or higher, at about 120 basis points. So that's just what makes up the fixed income returns that we look for in the portfolio. Again, duration, yield, base rates, plus the spread. On the next slide, very quickly, generally, stocks have been very strong this year. Again, relative to where we are in terms of monetary policy, bonds have been volatile and generally weaker. Yields have moved up and bond prices have moved lower. And you'll see that when we talk about returns on the next slide. The next slide, you can see second quarter, sort of in the middle there. These are public market returns. Equities, US, developed market, ex-US, and emerging, all in the black. And it's right below that, you can see that we've had negative returns of 2.3%, 1.94%, and almost 30 basis points for an investment grade corp. So again, the fixed income market struggled a little bit as we come through this process of hiking rates, Fed articulating the desire to stay longer and higher for longer. And that's negatively impacting our performance in fixed income. On the next slide, a quick look at equity markets. So your equity market returns have been actually strong year to date. And you can see all the green that's kind of to the left-hand side of the page. If you look at the Dow Jones, actually, that's not a really great indicator. Let's look at the S&P 500. The S&P 500 has been up 15.37% in dollars. And because we're dollar-based investors, the return's 15.37%. Let's jump down to the bottom where it says Asia Pacific and look at the Nikkei returns. The local market returns in Japan have been up 23%. But because when you're in that market, you're invested in Japanese yen, and the yen is weakened against the dollar, when you repatriate those returns back to the US, you only have a 10% return. And again, that's the dynamic that we look at in terms of when I talk about US dollar strength or weakness, it really applies to our non-US holdings and repatriating the values and how they impact performance. On the next slide, a quick look at bonds. And I don't mean to beat a dead horse with bonds, but yields have been higher. And you can see that on the far right-hand side of the chart. US Treasury 10-year yields are 34 basis points, give or take, above where they opened at the beginning of the year. Jump all the way down to the bottom, and you can see China, for example. China's economy is sluggish. They're cutting rates there. Chinese 10-year equivalent sovereigns are actually down 25 basis points in yield. So those bonds have actually increased in value. On the next slide, just a quick look at market returns. On the left, you can see equities, US, non-US, it's the Russell 3000 in blue, which has recovered nicely. The EFA index, which is non-US, and then emerging markets in red. So everything's kind of come back nicely. On the right-hand side, you can see the volatility associated with the Bloomberg aggregate. It's a fancy way of saying the bond index that's here in the States. And you can see the dramatic downturn that we experienced in 2022, the recovery, but again, then the sell-off on the far right-hand side, where again, bond prices have come down as yields have moved higher. Couple quick things before I get into performance. On the next slide, recent views, there's been some recent news. Fitch downgraded U.S. Treasuries to get back to the Treasury market to AA+ from AAA. Some have questioned the timing of that. Others think that it was probably overdue, but just an indication of some concerns about the level of deficits that we're running in the States and some of the political wrangling around our debt ceiling that we saw earlier this year certainly contributed to that downgrade. We also read and hear everything about artificial intelligence and the long-term potential for significant impact on U.S. and global economic growth. There may be some some exuberance associated with some specific names in the AI space in the markets today, but generally, I think the consensus is that this will have a dramatic impact on our economy and potentially on our investment returns longer term. On the next slide, some food for thought. So we had some bank crises, regional bank issues or challenges earlier this year, which has really limited the willingness and the ability for banks to lend money. So that blue chart, that blue line rather, is actually the level of bond loans that were made in 2022. And you can see they moved up consistently versus 2023, where they're slightly less than 2%. So because of the challenges that the regional banks have had, they've been shoring up their balance sheets. They've been more conservative and again, less willing and less able to lend money. And this will have an impact on the economy over time. On the next slide, this is why I think this is material. As the banks are lending less money, small businesses in the United States, almost 70% of the financing comes from these banks. So if there's a contraction in credit available for small businesses, it potentially will hurt their ability to grow and hire workers over time. Why this is meaningful, on the next slide, you can see almost half of all U.S. companies have fewer than 500 employees in dark green, dark blue, and light blue. And the credit contraction that we're seeing with banks reducing their ability and willingness to lend to these companies, these small companies, will have an impact on economic growth over time. Couple that on the next slide with the lagged effect of Fed rate hikes, and we've seen a number of the rate hikes moving up 550 basis points over the course of 2022 to now. Couple that with tighter credit conditions, and you can see that the expectation is that you'll see a faster and probably more significant downturn in GDP growth. On the next slide, maybe this is the last slide I'll go through. This is just looking at what the Fed hopes to avoid repeating that they saw in the 1970s and late 70s, early 80s. This was the twin peaks of inflation that we experienced back then. The Fed in the green line is actually the CPI that we're seeing today. There's an overlay of what we saw back from 1966 to 82 versus 2014 to 2030, and that's expected. So the Fed's very careful. They don't want to ease rates too quickly and have inflation come roaring back and have the same situation that they experienced during the oil price shocks in the 70s. Maybe skip ahead to the performance slides, Kate, if you would, on my slide 30. This is just a different look. So Dan Haas, who actually reports to Ed and to the Chief Operating Officer, Lynn Fleischman, has been spending a lot of time trying to enhance the way we actually portray returns and information, particularly around performance. And this is one of the slides we put out for beta test. So this basically looks at your plan, FIRE's total plan returns for 1 quarter, 1 year, 3 years, and 5 years. And it compares that relative to your policy returns, again, what your stated objectives are in terms of the asset allocation mix. And sometimes it takes us a while to get there, particularly in private assets. There's a ramp up that occurs typically over 5 years, so we have diversification. But you can see on the far right-hand side, your plan has actually outperformed your policy benchmark in your public market mix of 65-35. The only underperformance, if you will, is for the median Tux index. And typically those that index will have a much higher allocation to private markets than we currently have. On the next slide, I'll look at public market returns. And as I said, it's really a tale of 2 markets. You can see equities on the upper portion of the slide. For the second quarter, delivering 7.2% returns in U.S. equities, 3.2% non-U.S., and 3.4% emerging markets, whereas bonds have struggled. We've seen poor fixed income sell-off, TIPS, because of their relatively high duration, have also sold off. High yield, because it's got half the duration of the investment grade index, because you have higher coupons, you get your money back faster. It still generated a positive return. And at the very bottom of the slide, you can see that cash is king, delivering a positive return consistently over time. And again, those are for 3 months. So if you just multiply that by 4, it gives you a sense for what the annualized returns would be. We actually, I should mention, don't have an official allocation of cash, but we always maintain some level of cash to meet benefit payments and to make capital calls for your private assets. On the next slide, a quick look at public market excess returns. And you can see on the top, our strategies have actually underperformed the Russell 3000. And that's because a couple of the strategies actually have tilts that favor small cap stocks or small companies, as well as value stocks, and actually large cap and growth have outperformed for those, which is why there's been a drag on performance, certainly in the short run. And below that, you can see again, we continue to have some challenges in fixed income in our economically targeted investments. The 50 basis points in underperformance is really due to the nuances of that benchmark relative to where mortgage rates are today. On the next slide, a look at net private market returns, a little more positive story, particularly when you look at 5, 10 years, 10 years and since inception. The manager returns have actually been quite significant. And private equity had these are March to March numbers, March of 2022 to March of 2023. And you can see private equity, notwithstanding the challenges that we've read about, are still up a positive 1% for the year. Whereas core, non-core real estate have struggled a little bit more. Could be a buying opportunity, but an area you continue to want to invest in. Also, we have infrastructure in the 1-year space delivering an 8.6% return and proven to be a fairly good hedge against inflation, and opportunistic fixed income at 8%. And up on top, I should have said first, hedge funds through the end of June of 2.7% for the year.
Liam Guilfoyle, on hedge funds, what is our benchmark for them? What are we looking for hedge funds to return according to our asset allocation plan?
Yeah,
And our RPS?
it's technically the hedge fund index plus 100 basis points is the current benchmark. So it's indexed all under hedge funds. Yours may probably be more concentrated in long short equity and global macro. But I'd invite Neil to comment if he's on the line. But again, the performance has been
The peer group benchmark, not.
And then I can't hear what he's saying at all.
So it's Doug Mosley committee.
Sorry, Doug Mosley from NEPC. I made the comment that the benchmark for hedge funds is a peer group benchmark. So it's not like the S&P where it's a group of securities that represents an opportunity set. It's a group of managers, a large group that we use as a benchmark, and then we have a bogey above.
But now, again, Liam Guilfoyle, for hedge funds, do we tell the Axias of the world what we expect them to return over the course of time? Like, do we give them a return number? Say, our discount rate is 7. We tell them based on how our asset allocation is set up, we need you to reach 4%, 5%, 6%. Like, is there a number that they're looking to build their portfolio of hedge funds around to hit a certain return?
Now you're really looking for diversification, and you want to have assets that will outperform when your public market assets sell off. Actually, on the next slide, it breaks down. It just shows the fund to fund index, and that's the benchmark plus 100 basis points up on top. And again, some challenges relative to that fund of funds broad benchmark year to date. We typically don't target returns for hedge funds. Each strategy will have an expectation. But again, the reason why you're investing in hedge funds is really for the diversification benefits and income when other markets will typically end up. And I think that's an important holding. And Doug, please feel free to comment. But typically, one of the things that we've experienced, and then I've talked a lot about this, we've seen an increased correlation in public equity and public fixed income the last couple of years, which means that diversification benefits aren't really that healthy. At least right now with those correlations, when they go up, they both move in the same direction, up or down. And that's typically not what you expect to see. You want to have fixed income, for example, be more of a stabilizer for the portfolios.
But we do have a return target in the context of the asset allocation presentation.
That's right.
And the risk target, I would say, is just as important. We don't want to have a lot of assumed volatility from hedge funds. We want them to be similar in volatility to bonds, but do a lot better than bonds.
How many did that call and the text that I read reading in?
We can hear you, but can you identify yourself again?
So when you say that there's a target,
It's
what is the target? for
It's
hedge funds?
6%. Well, the assumed rate of return right now is 6% in our asset allocation modeling.
That's-
In the presentation, you're going to see in a little bit.
And what was it in the previous?
It's been lower. It does have some interest rate sensitivity, as most asset classes do. I mean, it's generally between stocks and bonds, and the volatility is similar to bonds.
Thank you.
So this is John Dewessa. I just want to make the point, and we'll talk about this more when we do the asset allocation. Think about everything in your portfolio is there for a reason. It's about diversification, but in some ways, think about for newer people, I'll say that are new to the board, right? If you think about the way that the portfolio is constructed, the fire department isn't of New York City. The FDNY is not one truck, right? There's an engine company, there's a ladder company, there's a rescue 1 through 4 or whatever the numbers are. It's constructed in a way that it should be an all-weather fire department in the sense of you don't know if you're going to the beach in Rockaway or you're going to a building in Long Island City, or if you're going to a house fire in in Queens. That's the same concept in a different way that your portfolio for investments is built. It's built to be all weather. So at certain points of a market cycle, some assets are expected to not perform at their optimum return profile just because their style is out of favor or something's out of favor. And that's why you have the portfolio that you have today. So I just think that that's helpful to kind of just break it down into something that I think we all around this table understand how the FDNY works. Some certainly better than others, but if you think about it in the context of what we do, that's I think a good way to kind of think about it from this board standpoint.
Thank you.
I think also one of the key takeaways on this slide should be all the green to the far right-hand side. Again, looking at 3 years, 5 years, 10 years since inception. These are excess returns. So this is outperformance relative to your established benchmarks for your alternative assets, which is, I think, very positive and significant for the portfolio's return over time. So a good outcome. On the next slide, just a quick look at rebalancing activity. So we actually go through a normal rebalancing on a weekly basis. We don't take liberty in terms of the targeted allocations, and what Doug will talk about is operating on the efficient frontier at some point. But we don't try to time the markets. We don't take tactical bets in terms of how we manage the assets. On a weekly basis, we sit down and we rebalance. So, for example, on this slide, you can see on the left-hand side, we're selling. We're moving from, so we're actually selling equities because they increase in value. Equities have outperformed bonds. And on the right-hand side, you can see that we're actually buying bonds. So selling what's done really well, buying what's underperformed, again, to bring us back in line. The other important aspect of what we do on those weekly calls is we make sure we have enough cash on hand to meet benefit payments and private asset capital calls. So it's all part of an integrated process, but actually this is a good slide to actually see how that works in reality. And with that, I'll open up to any questions. I think I may have gone over once pretty quickly.
The one question I had, Steve, in reading BAM's report, again, this is Liam Guilfoyle. I'm just trying to get to it because it's in the 1B report. And it talks about the 15-year return. And I think at the 15-year marker, we actually underperform the discount rate. And I'm just curious what that would be attributed to.
Yeah. Yeah, it's 15 years. It would probably be 2008, how we were allocated back then. I don't know. Well, that was like watching an accident in slow motion. You remember you had the disruptions with Bear Stearns earlier in March of
Yes.
2008.
It's page 165, 54. So we do 8.0, in the trailing 10 years, we do 8.06 compared to public market benchmark of 7.65. And in the 15-year, we're at 7.15, which again above the discount rate. But the PME was 7.37 for our benchmark. So it just says total portfolio return June 30th to 2023.
Yeah, I'm sure it had a lot to do with the global financial crisis and the so-on.
You,
You're not working. You can use it to smack me if you want. But it.
Absolutely. Is there any question, anything I covered too quickly or any questions if you have a chance to process anything that I've said, you can always reach out to me directly. I'm happy to go to any of this. Thanks, John.
so this is John Dorsey again from the Controller's Office. So now that we've heard the quarterly report, we're going to turn it over to Ed Berman, who's going to walk us through the risk report.
Good morning.
Okay, so this is John Dorsey again. So here's what we're going to do. We're going to hear from the risk piece, and then we're going to take a slight break between Ed's presentation and asset allocation and then we're going to reconvene shortly thereafter. So we'll just take a break, a short break after this, and then we'll reconvene.
All right. Good morning. This is Ed Berman. And so I'll walk you through the risk changes and give you a risk update. And we just heard from Steve on performance and the broad state of economy. And performance has been strong. The economy is always challenging and markets are volatile and the future is unknown. So two questions I want to address today. What's happening in your portfolio now? How may it perform going forward? Your portfolio has about 19 billion assets. It invests in almost all major asset classes. It covers 63 public managers, 328 private funds. And I don't know how many people touch your portfolio and make decisions, or thousands of people. There are markets moving every day. So altogether, your portfolio is exposed to a lot of risks, a lot of uncertainty. And you can see on this page what the risk is for the portfolio. In the lower right corner, the total risk for the portfolio is 11.5%. But the question is, what does this number mean? Should I be concerned with this number? You can see it came down by 0.7%. Is the source of concern? Just to remind you, we assess the risks in terms of performance. So when I say the total risk of the portfolio is 11.5%, what I mean is the expected return of the portfolio over the next 12 months will be within 11.5% range. With a caveat, there's about a 15% probability to exceed that on the upside and 15% to exceed on the downside. This number by itself is probably not very interesting. So let's put it in the context. So first of all, kind of peeling the onion, let's start with the markets. And for that, focus on column 1 in this table. We'll construct a very simple market portfolio, which is a blend of 65% MSCI ACWI, which is the broadest measure of equities, and 35% of Bloomberg Ag, domestic ag, which is the broadest measure of fixed income. So we crank this portfolio through our risk system, bar 1, and you can see at the bottom of the page in column 1, the total risk for this market portfolio is 11.7%, meaning we expect the return for this portfolio in the next 12 months to be within 11.7% range. This is our baseline. That's what markets give us. And you can see that the total risk for this market portfolio came down in Q2 by about 70 basis points. And we know it's here the impact of the markets. Well, we know that the volatility in the equities, in equity markets came down significantly for the quarter. So the VIX index moved down from 20 to 14. Markets are normalizing. And even in the fixed income markets measured by the MOVE index, the index declined from 122 to 110. So it's still historically elevated level, but markets begin to normalize. So we move to 11.7% total risk at the market portfolio level. The next step is to consider the policy benchmark, and that's really the result of asset allocation. So that's where instead of using just two assets, we further split the benchmark into US equity, developed ex-US, US core, high yield, and so forth. So you can see in the middle column, column 2, that the total risk for the policy benchmark, which includes asset allocation, declined for the quarter to level of 10.7%. This number is lower than the risk for the market portfolio, which is a good outcome. And it's really the result of the asset allocation in the board. So we expect by increasing more diversification to generate better returns at lower risk. So it's a positive outcome, it's expected. And you can see that the risk for policy benchmark declined in line with this market. So everything is functioning as expected. And finally, we arrive to column 3, which is your portfolio. So now we can put this number 11.5 in a broader context. So clearly it's aligned with markets. It's aligned with the strategic asset allocation. The risk for the portfolio declined by 70 basis points for the quarter, again, driven by the markets. And related to that, we have a second measure of risk, because when we talk about performance, clearly the total return is the most important result, the most important outcome for the system. But where we spend most of the time, I mean, the board, BAM, and consultants, we spend it on manager selection, where we're trying to capture the excess return over the benchmark. And that's why we have the second measure of risk, active risk, which is the measure of expected excess returns. So the excess risk of the active risk of 1.8% means that we expect your managers to deliver excess return within 1.8% range, up, down, with the usual caveat, this is 15% probability to do better or worse. You can see this number declined slightly for the quarter, again, in line with the markets. And that's where it's helpful to look at the historical trends of the charts. You see these two charts on the right-hand side of the page. It shows the last 12 months of the risk evolution for this portfolio we just discussed. Starting with the top chart, which shows the evolution of total risk, you can see that this broad relationship between these three portfolios, as just described, it held over the last 12 months, everything moving together. Your portfolio is driven mostly by the markets, so there are no unexpected surprises. And the active risk, or the measured excess returns, has been stable. It's coming slightly down, but there are no big changes for the quarter. So from the high vantage point, we see the portfolio functioning as expected. We see that the risks and returns in your portfolio are driven mostly by the markets. And we can see that the investment process is aligned with this objective. But that's obviously a very high level. Let's just dive into the details. Let's start with total risk. Let's look what makes this number and what drives this number. Then we'll have the next page, please. The next page. Thank you. So what you see on the left is the asset allocation for your portfolio, which should be well familiar to everyone here. It's obviously a blend of public equities, public fixed income, and alternatives. We do weekly rebalancing process to keep this asset allocation in check. And there may be small drift, a few basis points, but large part of DAM process is to keep your portfolio aligned with the benchmark. What you see on the right is what I call risk allocation. So this is the breakdown of your total risk, 11.5%. Why it is important to kind of keep this chart in mind? This chart shows what drives your risks, meaning your potential downside for the portfolio, but also the sources of return. And clearly you can see that public equities, which used to be 43% in the asset allocation view, now contribute 65%. Private equity, which is predominantly about 85% of private equity is invested in US-based managers, moves from 9% to almost 18%. So you can see altogether your portfolio has a very strong bias towards US equity, strong domestic bias, but 60% of your performance and risk are explained actually by US equity allocation between public and private markets. Fixed income shrinks materially from 30% in the asset allocation view. It's only 6% that drives your risk and performance. There were a few small changes for this quarter. The reasons you may have some changes because of the change in market structure, volatilities or correlations, and also small drift in asset allocation. But broadly speaking, I would say nothing material. The contribution of equities moves slightly higher, contribution of public fixed income slightly lower. We're talking a few basis points. So it's been stable and everything's functioning as expected. And to round off on the total risk, because I keep saying that risk is performance. So it's important to compare our risk projections with the realized outcome of the portfolio. Can we have the next page, please? Thank you. So what you see here is a comparison how the returns compare with the risk projections. Starting with chart number 1 in the upper left corner, the vertical bars represent our quarterly projections for the risk levels. The small triangles represent the realized outcome for the quarter. We usually expect the small triangles to be within the bars, within the projected risk. And you can see that for all asset classes, it held well. Starting with the first bar, this shows the entire portfolio, labeled as fire. The total return was 2 plus 2.7%, well within the range. And you can see that it's driven mostly by public equities. Probably the only noteworthy chart here, and I would say it's a boring chart, which is a good thing. Probably you don't want to hear in the risk presentation any excitement. So boring is actually good. Just to draw attention to chart number 3, this shows the contribution from 3 equity sleeves. US equities performed close to the upper range of our risk estimate. That's really a testament of the strength of US economy, strongly influenced by the fiscal response after the pandemic. You can see how strongly US equities outperformed developed ex-US and emerging markets. So, but everything is within range. And the last noteworthy point on this page on chart number 4 for fixed income, you see the returns for cash. And it's really currently, it's almost like free lunch. They don't happen very often in finance, but right now you see positive returns and almost no risk. So it's a positive outcome now. Comes with a trade-off of high inflation. So everything is functioning as expected within total risk or high-level exposure portfolio. So let's take a look at the active risk, which is a measure of excess return. It's a measure of your managers. Can we have the next page, please? Thank you. So just to remind, active risk in your portfolio runs at 1.8%. So meaning we expect the next 12 months excess return to be within 1.8% range. This chart you see on the screen shows the last 12 months of evolution of this active risk and also the breakdown into the components. And you can see this broad blue band that dominates the chart, which is private equity. And that's, I hope, not surprising for anyone. We benchmark private equity against the Russell 3000 with a 3% excess return. Private equity by its investment process type of companies it holds is very different from Russell 3000, so we expect a significant active risk here, so it's not surprising. You can barely see the contribution from fixed income, and that's by construction. You can see a slight orange bar at the top. So that's exactly how you want it to be. And public equities, that's the green band at the top of the page, contributes only 20 basis points. And again, that's not surprising given that the majority of allocations done through index or passive strategies. We take very small exposure to active management in the US equities, which is the largest sleeve. So the active risk levels are fairly low. So that's exactly as you want it to be. And to connect with the performance, can we have the next page, please? Thank you. The same exercise, we just looked at total risk. Now we're looking at the excess returns. There are two reasons why we want to understand how returns connect to our projections. First of all, it's a check on our risk models, which is important. I'm giving all this information, but you need to have confidence that our risk models function as expected. But also it's a check on your managers. So anything, any unusual exposures that they may take will show up in these numbers. Starting with chart number 1, which is a high-level view, you can see that, as described before, we take a small level of active risk in the portfolio. So the vertical bars are small, but all asset classes in the portfolio overall function well within the range. The most noteworthy chart here is chart number 3. I will look at the equities. And I keep saying that we expect these small triangles to be within our risk projections. Clearly, that's not the case here. So you can see for US equities, the outcome was well below the projected risk. And for EM equities as well. So what's happening here? In the emerging market equities, your managers realized a 2.5 excess return, positive outcome well above this projection. You have 6 managers in the emerging market sleeve plus 2 small allocation emerging managers. It's happened to be that all 6 managers delivered a positive excess return for this quarter, ranging between 60 basis points to up to 5%. Almost all this excess return was driven by stock selection. In the US equities, you have 13 managers plus 7 emerging managers, small allocation. There was a wider spread in performance, anywhere between -6 to +4% excess return. But almost all of it came from stock selection. So why did it happen so that in the EM equity stock selection was so positive? In the US equities, it was negative. And necessarily, it's more about market structure. So I'm sure you've heard many times how US equities, US market is heavily dominated by the big 5s, right? So the 5 large technologies companies, Google, Meta, Amazon, they altogether contribute about 25% of the S&P. Active management for the US-based managers became almost a binary decision. Do they own these big 5 companies or they don't? In the emerging markets, the environment is more conducive to active management. You have broader spread of outcome. You have lower correlation between the managers. It's a more positive environment for active stock pickers. And that's exactly what you see in the results. Worked well in emerging markets, and US equity was struggling for this point. So we've been talking so far about current exposures. I think it's also important to think about the future. How will your portfolio perform going forward? And we're currently going through a fairly benign period in the markets. One thing we know for sure, there will be future stresses. Look at the next page. We don't know what kind of stresses markets will experience. We do not know where it will come from. It can be geopolitics. It can be supply lines and just market volatility. Just think about the last 3 years. We have war in Ukraine, we have pandemic, we have inflation. None of it was predictable. So we don't know where the crisis will come from, but we do know what will influence your portfolio. It's the markets. So we cast a very broad net. we look at the broadest measure of markets. So there are really three types of markets, which is equities, rates, and commodities. And clearly your portfolio is very strong exposure to equities market, to the rates market. You do not currently have any commodities, yet commodities are important because it's here the lifeblood of the economy. It determines everything that goes to the manufacturing. It's the food we eat. It's the gas we put in our cars. It's the commodities, everything. So we selected, within each category, selected three most important markets. Not just the US, the emerging markets, and Europe. Within rates markets, we selected the 2-year treasuries, which is really the Fed fund policy. The 10-year treasuries, which is a proxy for the broad economy. That's where markets usually borrow. And the euro-dollar exchange rate, which is a proxy for the strength of US dollar. This US dollar being reserve currency influences markets and economies globally. In the commodities, it's copper, oil, and inflation, which is really the most important cornerstones of markets overall. We considered the last 4 years of these markets, and we asked our risk system a simple question. What will be the worst monthly outcome for this markets? You can see the results on this page. The probably the most striking outcome is how broad this range is. And that's again a reflection of how unusual last markets and a reflection of fairly difficult time in the broad economy. So how did these shocks will translate to your portfolio? You see it on the next page. So for the 9 markets we identified, equities, rates, and commodities, we identified the shocks you can see on this page. And we ran this through our risk system to estimate the absolute and excess return over the next year. You can see that the most exposure, the largest number for your portfolio is the S&P 500. Just as I mentioned before, the U.S. equities is the largest contributor to your portfolio, both for private and public markets. Going forward, it remains to be so. So it's consistent with the kind of exposures. You can see that emerging markets is the lowest contributor for the equity shocks. And it's important because of all the issues we're going to hear about China. So your portfolio has very low China exposure. In the rates, the exposures tend to be low. Just as we said, equities here determine the risk in terms of your portfolio, so it's holding going forward as well. And commodities, the important takeaway, it's the copper, which is here the proxy for global growth that drives your exposure. And finally, what we're looking for in your portfolio is what we call convexity. What I mean by this, we expect the upside for your portfolio to be better than the downside. This is the outcome of the asset allocation. It's always the exercise we do every 3 to 5 years, but it's something to watch out on the continuous basis. And you can see that on the broad range of shocks, your portfolio is performing as expected, meaning that your upside is better, at least not worse, than your downside. Probably the most extreme, the best case, you can see a line number 5 in the 10-year treasuries. On the upside, it's 2.4. On the downside, minus 2.1. So it's a positive outcome. It's as expected. And finally, focusing on the excess return column, which is the measure of your managers. The results are obviously smaller. It's consistent with the activity levels we discussed before and consistent with the current performance. So I'm not going to read the numbers, but broadly speaking, the outcome under the future scenarios, future shocks, are consistent and not surprising. So I'll stop there. No questions.
One question that comes to mind is Liam Guilfoyle is what is the reason we don't have any exposure to commodities?
We discussed this question. I'll pass it to Doug to address it broadly. Commodities can potentially be a strong contributor to inflation protection, But if you look at the returns of commodities across different economic cycles, they've been inconclusive. So there are different factors go into a commodities performance. They bring a lot of volatility or risk to the portfolio, but their Sharpe ratio, meaning the expected return, compensation per unit of risk, tends to be lower than other asset classes. The other ways to address inflation, in particular stock bond inflation, covers for inflation. Equity exposure provides a significant equity hedge. And we had the same discussion across all 5 systems. We considered commodities as part of our asset allocation. I think our internal view was consistent with all 5 consultants that just not a very efficient asset class for the portfolio. But I'll pass it down to provide more color.
Yeah, this is Doug Mosley from NAPC. Our experience with commodities are they work in a theoretical way when you're having these conversations about risk. And it certainly makes sense to try to hedge inflation through commodities. But when you look at the actual market, it's a derivatives-based market, meaning you're using commodity futures to try to get that exposure. Most futures have a kind of a time window to when they expire, and you constantly have to roll them. So you've got to come up with a basket of derivatives, and then there's a kind of a cost, a carrying cost of rolling them. And when you look at products in the marketplace, there aren't a lot of great products that have worked out well for investors like yourselves. We have other clients that have gone down the path of trying to add commodity strategies, and some of them end up being kind of very, you struggle with the returns. Certainly inflation's been low, so having it in place for the last 10 years, you would have been like, I earned 0, right? And you'd be unhappy with that. And then when the inflation spiked in the last 2 years, some of those products did really well for short periods of time, but then they just seem to be really inconsistent. Again, in part because of the market, these derivatives, and coming up with a basket of derivatives. He's using some key commodities like oil and copper as key indicators, and you can look at the whole market and see there's, depending on who you ask, there's 30 core commodities that trade in the futures market. But if you have a manager come in, some of them will tell you there's 50 or 60 because they trade other things that are, even more esoteric than copper or gold.
Can we corner the market on orange juice?
Well, this, he mentioned before supply and demand shocks, right? I mean, supply chain shocks. The commodity managers will come in and tell you, well, if you buy the basket of 30 commodities, we'll shift you to the ones that are undervalued, overvalued, attractive, whatever.
Yeah, but who determines that?
Some of them have supply demand shocks that are completely, removed from things going on in the economy, right? How many gold producers how many gold mines have gone out of business in some period of time? It takes supply offline, the price rises, but those are really long cycles, just like the oil market, right? You have to be investing when oil is at $20 a barrel to be able to reap the rewards for when it gets up to, 80 or 100. And it's a really long cycle. And most of the strategies I've seen don't survive the cycle because they get off track somewhere.
I appreciate it. Thank you.
All right, this is John Dorsa. Are there any other questions for Ed? Okay, so here's the plan going forward. We are going to take a short break. And when we return from the break, we are going to start up with the asset allocation discussion. I'm going to ask that trustees remain in the room. BAM is going to create a breakout session to bring in the appropriate people into a secondary room. And I'm going to ask everybody who's not a lawyer or a trustee to please exit the room for a very, very brief conversation amongst the trustees. Yeah, right now, between this and asset allocation. So BAM, I'm going to ask you to stop sharing the slide. Could let us know when the breakout room is ready to go. That would be very helpful. Thank you.
Great. And folks online, you can stay right where you are. We'll move the appropriate folks into the room right now.
The iPad left and came back in.
FYI, the recording is still going.
This is John Dorset. Great, thank you. So after a short recess, we are now back. And we have one more item for the public session. We're going to address the strategic asset allocation, where we are in the process, and to talk about the presentation. So I understand this is a joint presentation between BAM and NEPC. I'm going to hand it over to Steve Meyer to kind of give us the intro to what we're going to talk about. And then if you could just steer the conversation as best. And as always, I'm happy to interject when I feel I have knowledge to dispense.
Yeah, thank you, John. Steve Meyer speaking. So it's really not a joint presentation per se. I really just want to make a couple remarks in terms of how well we worked with Doug Mosley and his team at NEPC, and really to kind of turn over to Doug to kind of take us through his presentation. And Ed Berman has worked with me, and obviously Doug and his team as well. So we're here to answer questions. With that, turn over to Doug.
Great, thank you. So Doug Mosley from NEPC. I'm going to go through the preliminary recommendation that you have today in the presentation. We did hand out some hard copies here in person at the board, and it should be labeled as the fire asset allocation presentation on convene. It ties into the presentation that Ed just made on risk, right? When we talk about having a plan for the forward-looking allocation of our assets, we certainly, one of the starting points is where are we allocated today, but we bring together our outlook for markets, which, includes the key assumptions of risk and return, and then the less well-known, more complex assumption of correlation, which I can explain, but maybe we can leave to a later discussion. And so we've been going through the process with BAM and talking about our new reality after the basket clause was modified to give us a little bit more flexibility. We take the existing portfolio, we look at that, we look at the attractiveness of each asset class, and that is reflected in the return and risk assumptions. But we also talk about all the practical aspects of running this fund, and that includes, paying attention to how we implement each asset class. Is it all passive? Is it a mix of active and passive? Does it have to be all actively managed? The fees and all that. NEPC has a dedicated research team, and we do really two kinds of research. One is on manager selection, due diligence. The other is on asset class and asset allocation, and that's a big team at our firm that comes up with these assumptions every quarterly. So if you go to page 4 and 5, if you you can look at those, but our assumptions are based on the methodology that we established for looking at each asset class, its valuation, meaning is it richly valued? Has it done very well recently? Or is it oversold? Is it more attractive to buy in? And I always find it helpful to think about real estate, right? Especially we've got a couple new trustees in the room. If you live in the Bronx and your brother-in-law's got a house up in Lake George, and your brother-in-law paid $300,000 for it 20 years ago, and now it's worth $1 million. And then he tells you the next year he thinks it's worth $1.3 million. You can think about that asset as having appreciated, right? And now that it's $1.3 million, you think, wow, that's probably less attractive. I don't want to buy into that Lake George market and buy the house next to him, because that seems like a crazy idea to me. I wish I had bought when he did 20 years ago, right? So think about that. Real estate is probably the easiest asset class for all of us to relate to, but you can think the same way about equities. When equities have done really well, the earnings might be up, but they might be cyclically high. And that can mean that the market and the economy that drives earnings has grown faster. It can mean also that investors believe the economy has grown faster and that earnings should be growing in the next 5 years faster than they eventually end up growing, right? And that's important in terms of a concept, because you are buying an earnings stream, and that earnings stream has a growth rate associated. Bonds are a little different in that they're driven by your current yield. And then you've got to assess your, as Steve talked about, your spread risk, the credit risk you're taking, and the duration or the interest rate risk you're taking. So looking at page 5, I'm going to try to relate this a little bit because some of the questions we've gotten about this process in the last couple months just made me think of a good way to relate it. Because it gets confusing if you're a trustee and you see a performance report and you see, okay, hedge funds or bonds returned X over the last 10 years. And then we come to this presentation and, Mosley's telling you forward looking, the asset class is going to return something very different, higher or lower. And the best example is bonds. Right in the middle of that page, there's the fixed income category grouping, and it says U.S. aggregate bond index. And that's just a commonly referred to benchmark in the U.S. that has investment grade bonds. So U.S. government, treasury bonds, mortgage-backed securities, and corporate bonds primarily. There's some other things in there too, but they're all above investment grade. So the high yield market's not in there. It's the quality portion of the fixed income market. You can see our expected return in the middle column as of June 23 is 4.7%. I want to relate it to your portfolio because you've got about 18 or 20% in that grouping generally. And that's about where it's been for a while. It's been a little higher over some periods of time. In the last 10 years, ended in June, you've only gotten a return of 2.5% from it. So when you look at your performance report and you look at this report, you have to have the perspective is we're looking at current market valuation and pricing and thinking about the future. And one of the things that's distorted that and made it harder to kind of think about has been this period of low interest rates and low inflation that we've been through for the last 10 to 12 years. That depressed a lot of returns, in particular fixed income, for over a 10-year period, to the point where we were getting less from fixed income than the level of inflation. And that, for pension fund trustees and investors, that's a problem, right? We want to earn everything we want to earn should be above inflation. But in fixed income, if we've got a quarter or 20% of our portfolio in it, and we're only earning 1 or 2%, and then we have a year like last year where they sell off because rates rise, right? Because when rates rise, the prices in the bonds come down. And that spread chart that Steve put up there, same for the high yield market. When the spreads spike, that means the bonds are selling down, right? It means the market perceives there to be a higher risk of something changing, like defaults when it comes to high yield or interest rates when it comes to treasuries. So I'll just give you a couple other data points on this. Your hedge fund portfolio, you can see the expected return there is 6.3. Now, I know we just went through some numbers. I pulled the June number out of one of the reports, I think that's on Convene as well. And the 10-year return you've gotten from hedge funds has been 5%. So one of the conversations about hedge funds is always, well, if equities are returning 7 or 8, do we really want to invest in hedge funds if they're only giving us 5 or 6? And it may be in some bad or shorter periods, we're only getting 4 out of hedge funds. When you got 20% of your portfolio in bonds and you only earn 2.5, I'm really happy about earning 5 in hedge funds because the volatility is similar and hedge funds have less sensitivity to interest rates, which means they help us with diversification. Again, I believe firmly that your hedge fund portfolio delivers something between stocks and bonds over time. And now bonds at 2.5 for the last 10 years, I'm not so thrilled. But I do believe with higher rates, bonds over the next 10 years is more like a 4.5 to 5, which should put hedge funds something closer to 6 or 7. And that's kind of where we've got it at 6.3.
And is that, like you just said, hedge funds return 5. It says 10-year return. I apologize, it's Liam Guilfoyle. So in this book, it says that your 10-year return on hedge funds was 6.5.
That's our expectation for the future. That's the hard part here, is that we're looking in the rearview mirror. We don't just take the past and say that's what's going to happen in the future. We're looking at, with our valuation framework, inflation has changed, interest rates have changed, credit spreads have changed, the growth outlook may have changed. All those things factor in this. And so, I don't personally believe firms like NEPC are good at predicting the specific future, but this framework is really just a reasonable framework to say, hey, we don't know what's going to happen in the next year or 2 years, but over the next 7 to 10 years, I think we can reasonably assume that these returns will be realized, right? And now in the first quarter, as part of the beginning stages of the asset allocation presentation, BAM went through an exercise because you guys get five of these, right? Collectively, BAM does. You've got 5 systems, 5 consultants. They all have slightly different views. It did a great job of looking at the differences. He flagged some differences on specific asset classes. We kind of accounted for that in a lot of the discussions. But at the end of the day, the relationships between the asset classes for all the consultants are all the same. Meaning, someone may see hedge funds as 6, someone else may say it's 7, but it's still between stocks and bonds. And that's really what matters in the asset allocation discussion, right? And so, these are the returns. You can see I have the December assumption there in the second column from the right. We do this every quarter. And the other key takeaway is when a market's up, going back to your brother-in-law owns a house in Lake George. When something rises, we generally don't expect it to continue rising. We expect it to kind of pace back to a normal level, right? Real estate's the best example. When prices of buildings and your brother-in-law's house in Lake George are appreciating dramatically rapidly, they are generally outpacing the economic base of income and inflation. And they'll generally revert back at some point based on, conditions changing, whether it's a recession creeping up, which hits the value of real estate and the value of private equity and earnings, right? And people's view of the equity markets. Those type of things tend to make them very cyclical. I'll tell you one of the other things when it comes to the U.S. equity assumption here, which is a little bit of an outlier. We have a 4.6 return for equities, U.S. equities. You've earned 12% in the last 10 years. So again, Mosley, why are you telling me it's 4.6 when I earned 12 in the last 10 years? We've had 10-year cycles with the S&P where the return has been 0. So it's cyclical, right? And Steve and I may have a glass of wine and both agree that we expect over the next 50 years it's going to be 7 or 8%. But because it's been 12 in the last 5 to 7, 10 years, it's more likely, in particular because we haven't had a real recession in 10 years, that it's gonna trend back down. So if the market collapses in the next 12 months, and I come back in here, you're going to see that 4.6 is going to be much higher because the pricing has gotten more attractive to buy that earnings stream, right? You can measure the S&P's sales, total sales for all those companies and their total earnings stream, and you can see the trend. And you can also look at things like profitability of all the companies in the S&P. Profitability of companies has peaked, right? And now it's starting to hit. Higher interest rates are going to cut into that profitability. Higher wage inflation is starting to cut into that profitability. And it takes several quarters and years for that cycle to turn. I mean, the UAW strike is a good example, right? They're saying they want their piece of the profitability of the big 3 motor companies. They're going to get their piece. We don't know what it is yet, but it certainly is going to hit profitability on those companies unless they can all pass it on to their consumers, which in some cases, some companies can. So I'm off track here. I'm going to get us back focused. So these are our assumptions, a key to going into the discussion. Again, also key, your starting point of your portfolio and our views generally about markets. And if you go to page 8, while we try to put this together in a way, a framework that has a long-term horizon, and I made the statement that we're not good at predicting the future, we do try to signal to our clients that we think in the shorter term, things are more attractive than others relative to history and to our assumptions. And we, generally have this page to kind of signal our kind of 2-year outlook for the big asset classes. We think that public market equities are a little bit unfavorable right now because they're still overvalued. We thought that at the beginning of the year, and then they've been up about 15% through August. So, now that they're up more, we still kind of are anchored in that belief. Fixed income, because rates are higher, have gotten more attractive in both high quality or safe haven fixed income. So there's really 3 categories here. Return seeking credit is the third. Those spreads that Steve talked about have increased, meaning that the premium that you're getting over investment grade bonds has increased over the last 18 months or so. So they're more attractive. I use the 2.5% return for your 10 years bonds. Over the 10-year period, your high yield portfolio has returned 4.5. So high yield pretty consistently over any rolling 3-year cycle is going to beat investment grade by at least 2%, in some cases as much as 2.5 or 3. And right now, I think Steve used the spread over high yield is about 380. So it's 3.8% over treasuries you expect from high yield. And now we take that as part of our methodology and we say, okay, if I wrote the numbers down, but I don't have it in front of me. If we think that treasuries are going to earn 4 and we think that high yield has got 3.8% higher, the other thing we have to factor in is, do we think that risks have increased and we might lose some money on that high yield? So that yield is also offset by our assumption that credit might deteriorate and we might have higher credit losses reflected in that higher spread. So we like return seeking credit. In your case, that's high yield and OFI. And then public real assets we're kind of neutral on, private markets on here, but clearly, you know, over the trailing 10 years, your private equity portfolio has returned 4 or 5% pretty consistently above public equities. So it's in the 16-17% range. I think the exact 10-year number on a time-weighted basis from the performance report was 17%, right? So you're very consistently earning that there. The program is well run. We're comfortable moving you towards 10% at least. Your peers are hovering a little bit north of that, depending on how you define the peer group, right? The bigger public pension funds in the US have embraced private markets. Some of them are 20, 30, 40% combined in real estate, private equity, private credit, and private infrastructure. I don't know that you guys want to get that high, but we definitely want to kind of adjust and grab some more of that return from private equity. And we're also recommending more private credit. So I'm going to go ahead and cut to the page 11, which has some high level thoughts. And then I'm going to show you the policy mixes that we modeled. And, you know, we went through a process where we did some specific modeling. But when we looked at this, we call an optimization, right? And all an optimization is we take our assumptions and we say to the model, build us the highest returning portfolio for every kind of point on the risk line of that efficient frontier, which again it's an academic concept. It ties into the risk modeling that Ed's team does, but it's very relevant in that you want to try to build a portfolio that is efficiently structured and has a balance between all the asset classes that you're including. And when I say balance, the optimization is focused on balancing risk and return of the combined portfolio. But we also are going to try to balance liquidity relative to your liquidity needs. And we're going to balance, you know, when we go to implementation, things like paying attention to management fees, which categories we do actively and passively to save money, all of that, right? There's so much that goes into running this fund. At this point, we're just talking about the attractiveness of asset classes. When we did the optimization work, we let the model tell us where to put it. It's going to tell you when you don't constrain a model, it's going to tell you to put half your money in high yield bonds and half of it in, you know, private equity or something like that, right? And so the constraints you put on the model are what I call the realistic part of it. You know, I don't think, you know, I sit there and go, I don't think Liam and the UFOA and the UFA are going to tell us it's okay to put 50% in private equity. Right? Does that make sense? I mean, that's the real world hitting the model. And so, you know, when we looked at the modeling, you know, we looked at the idea that it was attracted to more high yield and more corporate bonds and more OFI portfolio exposure. And it also likes the private infrastructure space, right? The space that you've gotten into more recently, you've built towards a 3% allocation. The thing that's interesting about infrastructure is there generally are assets that have long-term value and long-term cash flows, and the components of the return to the investors like yourself are driven by that income, right? And they're contracted over long periods of time, and you can build a portfolio that gives you a good balance. And it also has some inflation sensitivity in those. The cash flows from those assets typically have inflation escalators, right? We know bridge tolls go up. We know airline fees go up. When there's more inflation, they go up a little bit more, right? Because they incorporate lots of different components. When we looked at the sources of places we wanted to reduce, we looked at some of the quality fixed income categories. The current policy has a pretty high allocation to US Treasuries and TIPS, which are both US government bonds. And we thought if we're going to try to balance the portfolio a little bit, we can take advantage of moving some of that money into credit and then into private markets. And so they're the primary source, along with the US equity market, which we're recommending that we trim by 4 or 5%. So go to the next page and we have the mixes. And I'll just explain the color coding here, because it is what we have here is we've got your current policy modeled, and those are your targets that are in place and approved right now. And if you go down towards the bottom part, you can see the expected return. We listed over 10 years, but we also have 30-year assumptions that are more long-term oriented that would tie to, say, your actuaries' work, right? Most actuaries don't want to deal with any period less than 25 years when they're talking about projecting anything. So we also have 30-year assumptions that are more normalized, and those are slightly higher, as you can see. So we're projecting an expected return over 10 years of 6.4, and I'll just comment and say that is lower than your 7% actuarial assumption, but you can see the 30-year returns are higher. When we looked at this 3 years ago, those numbers were even lower. So the 30-year was even below 7. And one of the good conversations we had about was whether we should lower it. And the reality is you had lowered your actuarial assumption, probably going back now 8 years, from 8 all the way to 7, which is unprecedented for a public fund to go that extreme. But I think, the actuary at the time convinced the powers that be that it made sense. And I think he went from being having an above average return assumption in your calculations, which would mean you were less conservative, to now below the average of public funds. And when they got to 7, market interest rates dipped for several years in there when we did some asset allocation work, and these numbers would have looked ugly. And now, because rates are higher, that works in your favor, right? And so now the expected returns are higher. And you can see as we look at mixes A, B, and C that we're going to look at some mixes that get that up a little bit more and try to get the 10-year closer to 7. But you can see that with the 30-year assumption at 7.5, that we're pretty comfortable that using using an actuarial assumption of 7 when we think the portfolio returns 7.5 means that we're being conservative, means that we're funding the pension fund using the 7%, but we may experience over a long cycle of 10 or 15 years actuarial gains if these numbers play out as we expect. I just lost my train of thought. So I'm just going to go through the mixes. Anything that's in orange is something we're reducing from the current target. So it's a source of funds to increase other categories. And then the yellow are categories where we've looked to increase the exposure. And, I talked about the modeling, but I'll tell you, there's a lot of subjective viewpoint here, and that we can see what the modeling is telling us, and that might make it a no-brainer to think about high yield increasing that allocation by 1 or 2%. But it's also thinking about the path you're on with private markets. You started out with a very low allocation of private markets. The last time we did this, we increased those targets roughly by 2 or 3%, depending on which target you're talking about. I think you should be very comfortable having, at least 10% in private equity. If you want to ask us to go back and model, 12% private equity, we kind of did that already too, but we've looked at those. But that's something that we can do as response to this interaction here today.
So Doug, John Dorsey, the Controls Office. So I know we have mid cap and we have small cap, and together it's 3%. At this point, given the size of the plan and the fact that we're mostly passive in large cap, does it make sense to still entertain mid cap, or to just let the small cap managers kind of just take away the mid cap piece and just run the small cap and a large cap? Because mid cap's always been an asset class historically that very few managers can get it right, because there's a lot of style drift to the lower part of large cap, or or going backwards into small cap. Does it make sense? And is the intent from this to keep mid cap, or are you looking at it as really small cap, but you're just kind of putting in the
the same bucket.
We put them in the same bucket from a modeling standpoint. We do think there's a difference between large cap stocks and how they perform from an earnings growth perspective versus small and mid cap companies, which we do group together. The reality is the S&P includes both it's dominated by large cap companies, but it includes some mid cap companies, just as the Russell 1000, which is a different index that you use with all your managers have. We actually think small and mid cap is more attractive. But from an implementation standpoint, which is kind of what you're asking, John Merschberg and his team, whatever we allocate to domestic equity, and we could combine those two and say for any of the mixes here, it's 22%. We're just going to implement it in a way where we don't make style bets and we don't make size bets. So we're going to have as much in either index or dedicated small and mid as the whole market has. Because we're not trying to make a bet and say we're going to shade more into small or mid cap, hope that those companies do better over a 7 or 10 year cycle, and then live with the consequences. We're saying we're indifferent when we implement. We try to be neutral from a size and style, so value growth basis. So it is an implementation question, really, John, that you asked.
Why wouldn't we want to have an allocation that has an expected 10-year return over the discount rate? Like, why continue?
Well, we
'Cause I think
do.
the last one,
Yes.
none of the mixes have a expected 10-year return over 7%.
Because essentially the short answer, Allison, is when we think about the funding of your pension fund, most of the UFA and UFOA members are going to have, 25 to 30 year careers, right? So we're funding, Bobby's pension fund over that time, and the city funds that arc of your actuarial needs over that long cycle. And so in the short term, we see that asset classes will sell off and become less attractive. And we've actually been through really an unprecedented period where inflation was still at 1 or 2% and bond yields were at 0 or 0 to 1. And usually you get some kind of premium from bonds over inflation. And that was because of what the Fed was doing for 10 years. We didn't get that. So we think the 30-year number is more relevant from the actuarial discussion. And the reality is market conditions have driven the 10-year expectation. Both the last time we looked at this and the numbers were worse than 6.4 or 6.7. And we accepted that there wasn't a lot we could do with our portfolio to react. We can't take all the bonds in the portfolio and say, bonds yields are at 1, we just got to get rid of them. And we're going to put it all in the equity market, right? We still have to balance the portfolio. And then we still have to have a long-term horizon with our real estate and private equity as we build it. All those asset classes were impacted by the low rates. And now they've come back up closer to quote unquote normal. And so it's the conditions that we can't change, I guess, Allison, that I'm saying that are reflected in the assumptions here. I would also say that our assumptions are relatively conservative, and that when we think of being conservative in this modeling, our risk numbers are probably a little higher than you've experienced. And our return assumptions, I think, they don't reflect, they're designed to be passively implemented. Now, with a caveat that private markets can't really be passively implemented. So we're not assuming any alpha here. We're just saying, if you just bought the S&P 500, this is what you should expect from stocks. But if we go and add alpha, then we either expect one of two things. We expect the fees we invest in buying that active management will be earned back in alpha, or we want a different risk positioning, which can be part of the story too. Steve, did you want to talk?
Yeah, I just want to underscore a couple of things, Doug, and I agree with Doug's assessment. I think what Doug also touched on earlier is, again, we just came through the 15-year anniversary of Lehman's default and the scarring associated with the global financial crisis. So things were really out of step with the normal cycle. We had 0 rates following the global financial crisis here in the States for 8 years, and slightly longer in Europe. So these were coming up of unprecedented times. Then we had a pandemic, and part of that process of repair with just a lot of disruptions that we continue to still work through. So if you look at some of Doug's and NAPC's return assumptions, they may look really low relative to what we've experienced for the last 10 years, but these were really not standard, or they're not representative of what would be considered a normal time. And to Doug's point, which I think he makes very fairly, is we did have some fairly lofty returns in private assets, in particular private equity and even public markets for the last few years. So it's reasonable to assume that those returns may not repeat themselves. I think these, Doug, if I had to guess, and I think you kind of touched on this, and we look at the passive index returns, there's no alpha here, but I suspect these are also somewhat conservative.
Yeah, we're using
Estimates.
9%, for example, for private equity. So a little bit different story than what you talked about with bonds, where we're assuming 4.5 or 4.6, and we earned 2.5 in the last 10 years. With private equity, you've earned 17. We don't think you're going to get 17 going forward. But again, we're not assuming manager alpha with our 9.1%. It's really just what we call like an illiquidity premium or spread over public markets. And you should be earning an illiquidity premium if you lock your money up over 10 years.
I apologize if I'm misunderstanding this, but is there a possibility that the model that would get us to the 7% that Allison asked about is bringing on too much of a risk factor in order for us to get there in the models that you're making up? Like if we wanted a model that got us to 7% at 10 years, and I'm assuming an additional almost 8% at 30 years, is that taking on too much of a risk according to the standard deviation that NEPC would be comfortable with?
So you could argue that you could construct a portfolio that gets you 7% and it would have less volatility than this right here. But in this framework, right, which of risk and return, which if you related to, if you ever heard of the normal curve, right? When Ed went through the risk report, he was talking about the distribution of returns, right? And the midpoint is what we're telling you you're going to earn, whether we're talking about an asset class or a portfolio of asset classes. And the width of that bell curve is kind of reflects your risk. So if you said, you know what, the city should take a more conservative approach, start paying in more to the pension fund, we're going to lower the return assumption to 4%. We could build a portfolio that gave us very little variability around earning 4%, and we'd have a higher probability of earning that, right? The part, when you think about the bell curve, though, is if you try to make the midpoint the 7, you've got essentially telling yourself you got a 50-50 chance of hitting your target over whatever rolling cycle you're measuring. Now, your actuary looks at that kind of those distribution of returns and what you've achieved. They also look at the actuarial data that's come in a similar way, right? And they look at the assumption for inflation and wage inflation and all the other components of the pension calculation, and they have similar kind of bell curve, right? And they say, here's our assumption. If we deviate from it, we got to put more money in, or if we do better, we can put less money in, similar to returns. So if you want to target this process with the 30-year being exactly 7, we could absolutely reduce risk in the portfolio, and then we'd have a conversation about the best way to do that. It probably would be maybe not putting as much in private equity or even reducing equities more. But then we'd still kind of be moving to the point where we didn't really have a margin of error over that 7%. Because, again, 30-year time horizon is something that you got to look at regularly. Why is your assumption this year different than 2 years ago? Understand the process, and then is it reasonable? And then are we taking into account all the other things we have to think about? Like, how many private equity managers can we hire in a year and give X number of dollars to? And so I think it makes sense to have it be somewhere above 7 because of that. But you could certainly say we want to look at something that would be a lower risk, and it would be only a 7% expected 30-year return. You're not really going to get to 7 very easily on the 10-year because it's a shorter time horizon, and expected returns for U.S. equities are depressed right now, forward-looking. Did I answer it well or no? Or
No, well, both would be high. I was assuming that if I assume a 7% return in the 10-year, that it would automatically, and I could be 100% wrong, assume a higher return on the 30.
Yeah, and you'd be taking more risk to do it. That risk number that's at the bottom, second from the bottom, would go up as well.
But
And the risk number relates to the variability you'll expect in the outcome. And I would tell you, I don't want to go down, we can talk about it, but I think of it, because I've been through this before, long cycles. It's also relates to the variability of your funded status. So with the US equity market, public pension funds are making a bet, that they're going to get that expected return. And if they don't, you can live and die by the volatility of the public equity market. And we've had periods where funded statuses have dropped because of that.
Well,
and that's what we want to try to balance.
and not to cut you off, but that's what my question was. If you assume 7% return, and then just by process of elimination, a higher 30-year closer to 8% return, does the risk number become too great for NEPC to say, we could live with that? And that was basically my question. Does going to 7 in order to meet the discount rate? Yeah.
Yeah, we wouldn't recommend that.
Yeah,
Sorry. I should be a little bit more short-term, answer things a little more concisely. I apologize.
no worries.
Yeah, and
listen,
it is-
I
but the
appreciate the
answer-
additional information, but
It's because I would use the 30-year number as my basis for thinking about the planning for the actuarial funding
gotcha.
and its volatility.
And so for me, I understand that we have constitutional protections, and I look at this very simply as I want to get milk from the cow. I don't want to kill the cow.
Right.
And so if the city can meet that, if I don't have to make them pay and we're not taking in that much more risk, but if you're saying that to take that risk is too great, then we're gonna have to work with that.
Well, we're definitely saying a couple things with this. We're recommending mix B, just to cut to the chase. We're telling you we're comfortable with private markets and their ability to generate a higher return that provides balance of risk to your portfolio. I would tell you, if you said to me, Doug, make the 6.7 be 7, I can't do it with large cap because I'm using a 4.6% return assumption. It's not going to move it up that way. It's just going to add volatility. I would also say that when we add more private equity here, we talked about this before the meeting, so I'll recap it. With private equity, it doesn't really quite fit into the volatility framework the same way public markets do. Meaning we can measure the volatility of stocks and bonds using daily, weekly, monthly, quarterly numbers very accurately generally. With private markets, the valuation is only adjusted quarterly, and it's adjusted more slowly so that it moves more like on an annual cycle. So the volatility number that you would measure and you've experienced in your portfolio over 20 years is much lower than the assumption we're using. We're penalizing it in a sense with a higher volatility assumption. So one of the things we looked at with Ed and his team was we said, let's look at just increasing private equity and taking a little bit out of bonds and a little out of stocks. And it increases the volatility because of that disconnect between the reality of the experience volatility and the way we model it in this framework. I know it sounds like I'm talking out of both sides of my mouth, but if we said, okay, your experience volatility over the last 20 years for private equity is 11 or 12% on a diversified portfolio, and we use that, the modeling would tell us to use 50% private equity, right? Mm-hmm. So the modeling is always tempered by the realities of all the things you have to consider when you implement, right? You don't want to have 40% of your portfolio in illiquids because if the public market sells off, it'll make it a hell of a lot harder for you to rebalance. But you also have to worry about the cash flow profile, which is another way to say liquidity of your pension fund. How much money is thrown off by all of these pieces of the portfolio, and how much does Pat's office through the comptroller's office have to push out the door to your members every week or month? And where are both those numbers going, right? If the comptroller says we're shooting out $1 billion a year to firefighters and fire officers who are retired.
It's about $1.4 billion.
Okay, so if that $1.4 billion, if that's going to $2 billion in 15 years, we have to make sure this portfolio earns the return, but also offers a liquidity profile that can pay those benefits 15 years from now. We can keep up, right?
Excuse me, Doug, on that point, to get to that expected rate of return. Would it even be possible with the basket clause, or would we be?
Yeah, the basket clause, we've been given more room. And so I think we've tried to keep a pretty good balance here. There's a slightly better risk balance. The Sharpe ratio at the bottom is slightly higher. I would say it's, marginal. But we think that there's better balance in having a little bit more in the private infrastructure and private equity and in credit where you're getting paid. One of the things we like about credit, and Ed made this point back in March or April, the high yield bond market has more risk than the investment grade market. But one of my favorite things is when the market sells off and those spreads widen, you can say, wow, the shit's hit the fan. We're worried about the credit markets. We're worried about the economy. But those 8% yielding high yield bonds as a basket, if you buy 150 of them or 200 of them, when the sell-off happens, that yield goes up to 12, 14, 16%. I think it was Steve will remember more. It was high as 18% during the great financial crisis, right? Now that's when no one wanted to buy anything, right? But even if you took that 18% yield and you said, wow, there's so much risk ahead, I don't assume I'll earn 18%, and you said I'm going to lose something more like 6, you can still do the math and be like, I have the highest confidence level in that basket of portfolio of high yield bonds, meaning I'm not just buying one, I'm buying 150, 200, 300, whatever it is. And it's been the most consistent in terms of generating a return, much more consistent than the equity market, which can be fickle because it's always worried about growth, right? It's always saying, wow, the market's going to grow, the economy's going to grow, earnings are going to grow. And then when it gets disappointed, it sells off dramatically.
Doug, I just had a quick question. So, I think we all understand that there are aspects of a totally unconstrained portfolio that don't respond to our situation. We have a lot of money that goes out the door, so we need liquidity. Extreme volatility can be problematic for the way the system is funded and for the headline funded ratio. I guess just following on some of the questions here, I'm just curious to know, not like from a discussion perspective necessarily, but like using NEP's consumption assumptions, what does a portfolio mix with that hits on a 10-year basis, a 7% return? What does it look like?
Yeah, so
Is there a mixed D? Just what does it look like? I mean,
Well,
it's gonna be hard to
no,
take on the
it's
fly.
very easy.
Can you
Like, we
send
can
it
put that
as it
together as a
exists?
follow-up. When I responded to Allison, I said it's almost it's a reaction to circumstances, right? And we've got the Titanic, and the circumstances in the ocean are changing, right? We can try to steer around some things, but there's some things we can't steer around, right?
Yeah, no, I
And it's
get
the
it. I
interest
get
rate
it.
level, inflation level. So what the portfolio would look like, you couldn't, with our assumptions, you would have to increase emerging markets equity, private equity, OFI, and probably private infrastructure by another 2 to 4%. Then you would be outside the basket. These mixes here, mix B and C, are using 7% of the basket of the new 10% that we have. So we're not using all of it, but most of it.
Yeah, so the basket allocation moved up to 35%. I think your analysis and your recommended mix has 29% basket. Ish. I think
Yeah,
that's
yeah.
what
I had that on here, and it was too crowded a page when I had all that other stuff on there. So
we have it. Yeah.
Yeah, so
29%,
29%,
which
right.
is reasonable because you don't want to get there all in one fell swoop. Now, we talked about base rates being higher. You don't need to take on so much more risk. This is also a very imprecise exercise. When we go through a process of assumptions, I think you said earlier, no one has a crystal ball. There's other elements that go into this in terms of construction implementation. And for example, so if we have an increased allocation of private assets, it will take us 5 years to implement because we'll do it on a go forward basis where we're getting vintage year diversification. We are still under allocated in a couple of the asset classes. So this is a process we need to go through, which we think will achieve good returns over time. I also think Doug said something that I couldn't agree more with. I think we've got demonstrated strong abilities in private assets. You specifically said private equity. So you're looking at average returns. We hope we're in a position where we can leverage the better performers out there, the bigger, more meaningful private equity firms over time.
Yeah, and our assumption doesn't even really reflect median returns. It reflects an academic framework or thinking about private equity as just a pure, you're getting paid for locking up your capital, not about the fact that if you've met with any of your private equity managers, you know, there's a component to growth, right? And there's a component to higher profitability that go into many of the private equity strategies. They're not buying the companies that grow slow.
Yeah.
They're buying groups of companies that grow quicker, trying to improve on them, recapitalize them, and exit. And so there's a growth bias there, which can be cyclical for sure. But you're also paying a low multiple, right? If we want to buy the S&P today, we're going to pay whatever it is, 18, 20 times earnings. Your average private equity manager, when they buy something, I mean, there's some examples of managers that will buy based on some growth rate for 5 years. But when they're buying on current earnings, they're usually buying somewhere between, say, 6 or 7 times earnings, and maybe as much as 10 or 11. So they're buying at that lower multiple, which is itself defines the risk premium of being illiquid.
So, John Dewis with Control Zone. So one thing that I'm mindful of is, well, it's a couple things. This is just a discussion, so this is not the end all be all. We're not voting on these today. So, so with that said, I understand that we're not hitting the 7 on the expected return over 10 years. However, just to clarify a point Doug made earlier, this is based on, at least in the public markets, this is based on a passive portfolio without any active return on top of it. So theoretically, if the consultants and BAM bring us managers that are good, they would manage not just the downside, but also the upside, and potentially beat the index. Not lose as much as the index when it goes down, but beat the index on the way up. So when I look at this, taking US large cap out of the equation, because that's where we tend to be passive. If you look at small cap, if you look at non-US equity, and if you look at emerging markets, it is highly likely that the managers that we would select would have the potential to generate alpha. And I think when you lay that on top of those are pretty significant assets, you're talking about 15% of the portfolio, that is where you have the potential to hit the 7. Plus, on private equity, we're looking at the broad landscape, right? We typically try to find first and second quartile managers, which I'm sure when you extrapolate those from the universe, may potentially drive the return better as well. Because I think this is taking into account what we reasonably expect private equity to do. And there's going to be managers that knock the cover off the ball, and there's going to be some that don't. But I think that at the end of the day, we've historically had a pretty good batting average of picking more winners than losers, if you will. And if that plays out over time, that should also help us get to the 7. And I'm talking about the real number, not the expected. I understand the expected is based on what we think or what Doug thinks or NEPC more broadly, and they believe that the passive universe would do. But I think we can't discount the fact that we are active investors in at least 15% of the assets, or at least a dozen% of the assets.
That's right.
That are on this page. So
and we do have some clients that'll say, can we model the alpha? And to Steve's prior point, it's like this modeling process implies a level of precision that does not exist, right? And so I tend to try to talk my clients out of doing that. But when I look at this page, I think of non-US equities specifically. You have almost consistently over rolling 5-year periods earned 150 basis points over your bogey for your combined international equity portfolio. It's been probably as high as 2 over some of the longer term. So if you think we can earn 1%, be conservative over that, then yeah, you'd be adding 1% to that 9% of our portfolio, or maybe 15 if you combine emerging. And you could do that, but I don't think it's necessary to make the trade-off and have the conversation that we're having about asset classes. You can know that, US large cap, we don't do that much more over the benchmark. And
yeah, I know, I certainly think that's fair. I was just kind of making that point since this is just a discussion on what we're looking to do. I think people should just be aware of that nuance.
It is
in this. It's hard to look at this document, knowing the funded ratio here, and not understand that what if someone's looking in, why are you know, why aren't you adopting something?
And maybe I
70%
can
bogey?
relate it to some,
Realizations of that.
maybe I can relate it to something that you guys would appreciate without hopefully going into dangerous territory. When you think about the assumption, the actuarial assumptions, there's an inflation assumption, right? And if the actuary comes in and says, hey, long-term inflation assumption for wages, which is a sensitive thing, right, is 3 or 3.5, whatever it is. You guys know, as being at the bargaining table, that sometimes you go for many years without a pay raise, and then you negotiate a raise that might bump up pay 5, 6, 7%, right? The actuary will say, I pay attention to that, but I care about the long-term trend. And the long-term trend has some relationship to our assumption that we're using when we calculate the present value of assets and liabilities for the pension fund. So we know in the short term, it's going to move around just like markets do. But in the long term, if we get to where we want to go with the 30-year assumptions here, then we're getting to 7.5 when our bogey is 7, which we can still talk about.
No, but what John just said, to be honest with you, it cleared up, like, I wasn't assuming alpha in any way, shape, or form, and I didn't know that this did take that into
Yeah.
account.
It's conservative. It's about it's the relationships between the asset classes.
Can I also add, so there's another thing we haven't talked about, it's portfolio construction and implementation in terms of, and one of the advantages that the Bureau of Asset Management has and the fire pension plan has is we collectively negotiate better economics for all the private asset deals based on a buying power of a $260 billion base. So the economics are going to be that much more powerful when they flow down into the portfolio. You're getting lower fees, co-investment, no fee, no carry, for example. And we're able, Anash and Petch and their teams are able to negotiate actually very competitive fees with the top performers. So we do think that that'll be a driver of outperformance. In terms of where we are in the public markets, I mean, I think that's also a discussion we need to have about the active versus passive. Are we better off in an active strategy relative to passive? And what do we think will come out over time? Because I do think it's possible for managers to generate alpha consistently. It's very rare. And we have to look at other things. I know Ed's done a lot of head work in terms of just portfolio construction and how many managers you'd want with an active strategy. So you don't wind up getting, basically, if you add them all up together, you've got the index anyway, and you're paying active fees. These are the things that we're working on together.
So
We had been discussing for a while the fact that we believe we had too many managers, and too many managers really means that you're working towards the mean anyway. So it goes back into the argument, and I appreciate the fact that the comptroller's office has been willing to listen to us on doing investments that are smaller, that really are only looking to raise 1 to 2 billion, and may only be able to include smaller pension funds, but would like to know, especially, I guess, in the STAR report, how close we are to coming to that and implementing that.
So I will just say this, John Dorset, while I don't speak for the investment side of the Bureau of Asset Management, I would say that I think that's an implementation question rather than an asset allocation question, in the sense that we need to determine what road we're going to take, and then we can figure out what car we're going to take, or bicycle, for those of us that care about the
yeah,
climate.
it may impact how you feel.
What bicycle will take to get there.
This process is indifferent to that.
Yeah. You can get there a bunch of different ways too. So I know Anash has done some analysis just in terms of the potential expected increase in private equity across the 5 plans and how we would implement that. And we can go down the path where we simply increase and max out on our across the current private equity firms we invest with on a re-up basis. We probably wouldn't want to do that. We do want more diversification. We want to be able to move into the medium-sized plans as well and negotiate better terms there as well. So I do think, again, implementation in terms of resources and in how we allocate those resources over time.
Great, thank you.
The other way to look at page 12 is to look at the pieces and say, hey, as a trustee, am I comfortable with private equity and moving it from 8 to 10? And some people at the table may say, I'd love to do it 15, right? And that would be a reasonable thing to advocate for. We came out thinking about the practical side of it, thinking you can easily go to 10. we wanted to explore higher, we could model that, but then we're gonna bump up against the basket if we do some of the other things we want to do, which is OFI. You know, hedge funds are in there. You can see the model, A and B go up to 6 and mix C is up to 7. So it's a little more hitting the basket. And the private infrastructure, we did model going to 10, right? Could you get to 10 in 5 years? Probably not. It would take you at least 5 years to get to 5. So we went with 5, and we can revisit this process yearly or every 3 years or every 5 years and make adjustments.
Can I just make one more? Ed's been my business partner on all this. Ed, anything that we haven't talked about, any observations?
And maybe running slightly ahead of myself here, but just we have a privilege of seeing allocation across all 5 systems. And each system is unique, and each consultant has their own assumptions. And if you look at the NEPC assumptions, they'll be different from other systems. What's important to me, and I was looking very carefully, is the relationship between the assumptions, the relation of how the asset classes will move. So ultimately, look, of course, we want to see the projected return at 8, 9, 10%. Sure. What we really want to see is the realized outcome to be about 7%. And that's, we completely at the mercy of markets. So we adjust asset allocation, but ultimately markets will give us this return. It will be what it will be, right? So looking across all 5 systems, we're in a position to put the assumptions across 5 consultants on the same platform. So using consistent approach across all 5 systems, I can tell you when you put it kind of apples to apples, the difference tends to disappear. So even though NEPC's assumption for US equities will be different from Rockefeller assumption for US equities, the correlation will be different. But when you put it all together, it's remarkably similar. And ultimately, what's most important is the stock bond split. It's the domestic buys because US markets tend to be more aggressive. It's the level of private equity. It's important. But that's where I get the limitations. We are constrained on basketballs. So it's very little room. We are constrained with implementation. It's just we cannot put 10% in private infrastructure. We just cannot get there, right? So when in all 5 systems face the same restrictions, same limitations, when you put it all together, even though the projected returns will be different because the assumptions are different, chances are that the realized outcome will be consistent. And that's here what we're looking for this consistency. And that's where having access to all 5 systems, the privilege you're seeing across 5 consultants was very helpful. I can tell you, even though NEPC's result, capital market assumptions are unique to NEPC, the net result, the net outcome is actually very similar.
Yeah, and we had some great conversations, and I can give you some examples where the other 4 consulting firms had slightly different assumptions or about one key assumption like correlation, and we had a really healthy discussion about it. And I actually felt like, you know, the outcome should be adjusted to reflect that in our reporting, because it made sense when, you know, a couple of the asset classes that have shorter histories, our correlation number was saying, oh, there's a lot of diversification in TIPS. And the other couple of the other consultants were like, there isn't. And here's why, because TIPS is a bond category with the shortest history. It only goes back to 1997, very short relative to the others that go back 50, 100 years. And it was how TIPS can perform in a sell-off, a market sell-off, like the Lehman sell-off, and how they're different than treasuries, because no one cares about inflation when they're worried about Lehman failing, right? And they sell off TIPS and they buy treasuries instead. And if you assume the correlation's the same for either of those, like they're interchangeable, you can be wrong. And that was kind of the key difference in our assumption.
If I could just make one or two other comments. So we've had the benefit of some peer analysis done. So if you look at the top 120 asset managers of similar size in the US, the allocation to alternative assets is probably on average about 37%. And there are others that are above 50%. And we're constrained at 35. And I think this recommendation, which I think makes a lot of sense, is at 29%. So there's more we can do over time. The other side of it, though, is that, you know, we actually have a significant amount of public assets and equities and fixed income, which means we really don't need to worry about liquidity. We have plenty of liquidity that we can access with a phone call. So there are other instances out there where there's some of the peers out there with a much higher allocation of private assets in the last year were forced sellers. They had to sell because they were above their investment policy statement or restrictions. We never want to be in that position. We do want to maintain some level of buffer for the basket clause under 35%. And I think this mix makes a lot of sense. And it will be able to, over the course of time, hit those targets.
Just on that point, Steve, how much buffer have we generally maintained when it's been at 25%?
About 2 to 3%.
All right, and so this anticipates a 6% buffer.
Yes.
Okay.
Yeah. And again, part of that, Brian, is because of the base rates are so much higher. You don't need to necessarily take on all that risk. And to Doug's point earlier, a lot of it has to do with implementation and timing. How much can we reasonably put to work with vintage or diversification? And I think this makes sense.
Yeah, what I see is a bad habit sometimes with some systems that over rely on the modeling is if someone, let's say a public pension fund had no private equity and they got their performance report at the board meeting and they're ranked in the bottom quartile. And someone says, well, why are we in the bottom quartile? Well, your peers have 10 or 12% private equity. They've got 12% in real estate, and we've got half that in real estate and no private equity. If you would say, okay, let's look at the modeling, we got to get our private equity target from 0 to 10. If you do that over a 5-year period, it can either work really well or really poorly because you try to build something too quickly and you already have a nice private equity portfolio that's mature, and all you're going to do is just pace it to expand from 8 to 10. And that'll take you a couple of years at least. But if you chase what everyone else is doing, you end up sometimes not where you expect, right? Because you get a concentrated portfolio. Real estate's the best example of that too. And private credit, I think right now, private credit has started to weaken slower because of the lag. Some of your peers have added 10, 12, 15% in private credit, and that's worked really well in the last 7 years. But we haven't gone through the full credit cycle yet. And a lot of that private credit is going to get marked down in the next 2 years. And some of those plans are really going to pay the price for how quickly they built it. And it's unfortunate, but it's something that they're all trade-offs. You can build an infinite number of portfolios, but I think this is the best portfolio for you guys is mixed big.
Doug, can you also comment on the private real estate allocation? I know we talked about combining core, non-core to provide a little more flexibility.
Yeah. So when Ed did his assumption comparison, we were using the December numbers. All of the consultants, I believe, have a core real estate and a value add or non-core, and then some of them might have debt or other pieces of real estate. Our assumptions were markedly lower than the others, in part because we have a methodology where we use a data-driven approach from usually it's a month prior to the quarter end. So call it November of last year. We hadn't seen the write-downs yet for that first wave in real estate. So our assumption hadn't started to go back up yet, and others had because they were looking kind of forward, thinking about some of the write-offs. Ours have caught up, but one of the other things we did to adjust here is because your portfolio is really, it's skewed a little bit more now towards the goal of having value add and opportunistic be more than half the portfolio. We use the value add and opportunistic assumption in part because our assumption was lower anyway. We wanted to use the higher one. And so that's reflected here. We're using one assumption. That's the value add real estate.
So the only other point I think to talk about in terms of strategic asset allocation that we haven't touched on is the 0.5% of 1% allocation of cash.
Oh, yeah.
And that's not tactical. We're not making bets. We're not putting money in cash with the expectation of legging into trades over time. It's really just a recognition that we have benefit payments we need to make on a monthly basis, and that the assets, the private assets that we currently own often aren't fully allocated. So there'll be capital calls we need to meet over time. So that allocation is just really to recognize the reality of how we've been managing the portfolios for quite some time. With a zero allocation, we still rebalance on a weekly basis. We still make sure that we do cash forecasts weekly. So again, that was the only change that I thought was noteworthy.
And in your fixed income portfolio, you own a mix of short, intermediate, and long-term bonds.
Right.
You have bonds in your portfolio that mature almost every day, right? And so there's a lot of liquidity there with, in particular, the Treasury portfolio. So that's it. We're not asking for a vote. I think any follow-up that you want to filter to Bam or to me, we can bring any follow-up discussions or questions to the next conversation, which I assume will be in October. Thanks. I know you're on a tight timeline with others too. So.
Okay, so that concludes the strategic asset allocation discussion. If anybody has any questions, as you've heard from both Doug and from Steve, please feel free to raise any questions between now and the next meet, and we're happy to address those or have those by the. Okay, we have two more small issues for public session before we enter into executive session. The first, well, actually, you know what? I'll do the second one first because Liam is just walking back in the room. The first one is to remind everybody that on Friday, this Friday, the 22nd, and next Friday, the 29th, is what we are referring to as BAM University. That is an opportunity for the trustees of the 5 pension funds to hear directly from the staff of the Bureau of Asset Management and explain exactly what we do for you. I think that the key takeaway from this is there's a lot of people in the course of a deal that are involved in it before it gets to you as a board, or I should say to us as a board. After we vote, there's a whole slew of people that are involved in managing that relationship going forward. And I think that this is going to offer a great opportunity to actually see those people that are actually doing the day in and day out of pension management. And you can actually understand a little bit better about the process and what it is we do. One of the other things that I think is beneficial is the trustees of the other 4 systems are also invited. So it'll be a chance to kind of meet some of the other people that have experienced the same questions that you guys have from time to time. And I think for newer trustees, it's just a great way to start a good relationship with the Bureau of Asset Management, actually understanding how all of this stuff fits together. There is no voting that day. It is not a meeting of the board. Please come casual. Steve has assured me he will not wear a tie that day. So for the first time since 1985, he's not going to wear a tie to work. That's going to be very exciting. So anyway, just wanted to encourage everybody to come. If you have any specific questions about the day, please feel free to grab Allison and I. And just to let you know, the first day we are going to talk about private markets. We have a great guest speaker who's coming in on the second day. Okay, sorry. Oh, sorry. So we have all right. So I'm not always right. So we have one day where we're talking about alternative deals, how private equity, real estate, how those deals happen. The other day will be about how we do public market managers. So I think it'll be very interesting. We do have a really good guest speaker. Can I say in public or so we have Jack Lew, who is the former Secretary of the Treasury and Chief of Staff at the White House, who's going to come in and talk to us. And actually, I believe he's also a nominee for Ambassador to Israel. I think that was in the paper. So he'll actually be in to speak to the trustees in person. So I think that that'll be a very interesting going on as well. Okay, so with that, that's the notice. The last item for public. There was a document sent out in convene about the ability to join the Labor Rights Investor Network. I don't know if there are any specific questions. If there are, Allison probably has slightly more information than I do, but I don't know if between the two of us, we have we can answer every question, but we can certainly try. I think that the highlight here is we are, well, a majority, if not almost all of the money that is managed in this plan is managed on behalf of men and women in labor unions. And we are very cognizant of that as a pension fund. Even on the city side, we are cognizant of that. We are also cognizant of the fact that a majority of the money that we're responsible for in the Bureau of Asset Management is held for members of trade unions and other unions. And we are often approached about joining certain networks that are designed to bring about labor rights among as investors. And we were approached with one group, the Labor Rights Investor Network, which is a new organization And they have reached out to us. We have worked with them in the past on several initiatives. And they are now really formalizing the way that they do business. And they've come to the 5 city systems through the controller's office, asking if the 5 funds would like to join. And we thought rather than having the controller join as a single trustee or one entity, or even the office, we would ask the boards if they wanted to participate. So Allison, I don't know if you have anything you'd like to add?
The only thing I'll add is the organizations that are making up the sort of coordinating committee, which they're asking us to join, are the labor unions and workers' rights orgs that we have been co-filing a lot of the shareholder resolutions around freedom of association with. So these are folks that we have been partnering with on an informal basis. And the ask was whether we would be willing to formally lend our name as part of the labor rights investment. And I'm happy to spell those groups out if it's helpful.
Does this curtail our ability to invest or change anything?
Absolutely not.
Affiliation. What is the benefit to us for affiliating with it?
The benefit to us for affiliating with it is to have our sort of name and imprimatur on the, to say that it's really to say that we are a member of the Labor Rights Investor Network, and that as we do investments and look at our shareholder responsibility, and that one of the key priorities we have is how workers are being treated by a company. But it's I guess reputational value, nothing more or less.
Do we have something on the organization like a?
Yeah, it was circulated by both email and in convene. I can hand you I don't know if you have access to convene right now, but I can hand it to you.
And then who was that just speaking besides Ms. Hirsch?
John Michael.
Thank you.
You have, I don't remember seeing a list of who has signed on. I definitely read the memo. I just don't remember seeing a list of what other unions have signed on.
Sure. So the unions are, as part of the unique is my, okay. I'm going to keep going until somebody says to stop. Unique Global, which is a coalition of global service worker unions. Hold on. Switching mics. So Unique Global is basically a consortium of like the global consortium of service worker unions. So like SEIU is a member of Unique Global, RWD is, and the equivalents in Europe, Australia, etc. UFCW, the AFL, the Strategic Organizing Committee Investment Group, which is basically for folks who know labor history, Change to Win, when some of the unions split from the AFL-CIO to create Change to Win. That was a failed enterprise, but the one thing to come out of that was sort of an organizing coalition of the Teamsters, SEIU, I think maybe UAW, but I might be misspeaking, and others. So they now really only do sort of cross-sector organizing and shareholder work. And then the CWC, which is the Global Unions Committee on Workers' Capital, which is based out of Canada. We are the only, currently the only U.S. public pension. The 5 systems are the only U.S. public pensions being asked to join the leadership team.
What, if any, drawbacks do you see to it?
Honestly, I don't see any. There's nothing in here that limits our ability to do things on our own or in coalition. If there is something that the group wants to do that we don't want to do, we can bow out. I can't really foresee any negative impact on us. So I don't know.
When you show Michael, when you say what they want to do, what is it that they want to do or ask us to do? Or
this is why I don't think there's any negative. I can't. I'm sorry, I know, I need to talk. Talk. My kids would say bad advice, John Dorset, bad advice, when that line comes up on the song. Don't let them know what you're against or what you're for. Okay, sorry.
Stopped again.
If I could, and it's not, like, I'm all about the conversation, it's just that I have two very new board members that haven't had an opportunity to really go over all the specifics of this, so if no one's got a disagreement, I'd like to table this for the next meeting. Thank you.
Nobody can hear me, but.
Yeah, there's no disagreement. I just want to remind folks, we are meeting next Wednesday. So if there is a desire to do it at the regular meeting instead of the investment meeting, we could do it there too, but
Absolutely.
just remind folks.
Perfect. Great.
Okay, I'd like to make a motion to exit public session and enter into executive session.
Motion.
Second,
Bobby Eustace.
I made the motion. He seconded it. So
Second.
chorus of ayes.
All right, any opposed? Hearing none, the motion carries. We are now in executive session. Can we please turn off the recording and confirm that anyone that needs to drop off the, great. So we are now in public session. We are entering the firefighter variable supplement fund meeting, and we will kick it off with a roll call.
Thank you. Okay, firefighters VSF, for the mayor, Mayor Adams,
Ryan Berge representing Mayor Eric Adams, present.
Controller Lander's office,
Allison Hirsch, representing Controller Brad Lander.
Commissioner of Finance Nyblock,
Phil Dukes for Commissioner Nyblack.
and for the UFA, Mr. Eustace
Present.
and Mr. Viola.
Chris lost his connection. I could take his proxy for now until he reestablishes it.
Okay, so we have Mr. Eric Bischoff with the proxy for Mr. Viola. We have a quorum.
Thank you. The board is requested to note the receipt of the quarterly reports. We now need a
So
motion
much.
to adjourn the firefighter
Motion,
VSF.
Bobby
meeting.
Eustace. Eric, you got a second?
Oh, second, Allison.
Any opposed?
Second Bischoff with Viola's proxy.
Any opposed? Hearing none, the motion carries. We are now starting the fire officers variable supplement funds meeting. We will begin with a roll call.
Okay, for Mayor Adams,
Ryan Berge representing Mayor Eric Adams, present.
okay, for Controller Lander,
Allison Hirsch, representing Controller Brad Lander.
and for Commissioner Nyblock Finance,
Phil Dukes for Finance, Commissioner Nyblack.
and for the UFOA, Mr. Joseph Camastro.
Present.
And Mr. Liam Gilf.
Here.
Okay, we have a quorum.
Excellent. Thank you. The board is requested to note the receipt of the quarterly reports.
So noted.
Thank you. We now need a motion to adjourn the fire officers VSF meeting and resume the fire pension fund meeting.
Motion, Liam Guilfoyle.
Second, Allison Hirsch.
Any opposed? Hearing none, the motion carries. We are now rejoining and we are in the fire pension fund meeting. During the executive session, the board discussed various investment matters. We have reached the end of our agenda. I would welcome a motion to adjourn.
Motion to adjourn, John Dorset.
Second, Liam Guilfoyle.
Any opposed? Hearing none, the motion carries. We are adjourned. Thank you all.
You-